Okay, let's jump right into it. We're heading to Japan today to look at something that's pretty crucial but often overlooked: regional banking. We're doing a deep dive into the really aggressive strategy laid out by the Hachijuni Bank. This is a story about a regional powerhouse trying to, well, completely rewrite the rules for how local banks can thrive when facing some huge demographic headwinds.
Yeah, we're pulling apart their 2025 annual report, which just came out. And at the heart of it is this huge strategic overhaul in Nagano Prefecture. And this is so much more than just a standard bank merger. It's a very explicit plan to use scale, technology, and their own people to fundamentally change how the market values them.
And the main event here is the creation of this new entity, Hachijuni Nagano Bank. Hachijuni Bank and Nagano Bank did an equity tie-up back in 2023, and now they're on a straight path to a full merger on January 1st, 2026. But this is all happening against a financial backdrop that is, frankly, really confusing.
It's a total paradox. I mean, for fiscal year 2024, Hachijuni hit a consolidated net income of $47.9 billion. That's a record profit for the second year in a row. It's up big year over year. So by all the normal metrics, the bank's doing great.
But the market completely disagrees. And let's unpack that, because despite these, stellar profits, as of March 2025, the bank's price-to-book ratio, the PBR, was sitting at around 0.5x.
So you have a successful, profitable company trading at half its book value. For you listening, that basically means the market is saying, we think this bank is worth more broken up and sold for parts than it is as a going concern. And that PBR gap, that's the existential crisis that's driving every single thing we're about to talk about.
So here's the key question then. Why does the market distrust these record profits? Is the view just that with population decline and aging society, that these numbers just aren't sustainable, that they're going to fall off a cliff eventually?
That's precisely the skepticism. The low PBR is reflecting this deep systemic doubt about the entire regional banking model in Japan. The market's waiting for proof that Hachijuni can actually break free from those demographic chains. If they can't show real structural change, the market just assumes their profitability will collapse.
And that structural change is what we need to get into. They're not just looking for a bit of growth. They want a complete re-rating from the market. Let's start with the merger itself and the very ambitious goals that come with it.
The merger with Nagano Bank is tied directly to this idea of revitalizing the local economy. They use this phrase, qualitative prosperity. It's a mission that's, bigger than just profit. It's about quality of life, the environment. Basically saying that Nagano's strength is their profit engine.
That's a nice goal, but mergers are messy. They're costly, especially when you're trying to combine two different IT systems. What's the immediate hit they're taking?
Well, they're being pretty open about the short-term pain. They expect some negative synergies at first. There's a provision for a loss on canceling system contracts. It's a little over $2 billion. There's just a necessary cost to get everyone onto one platform.
And the payoff they're projecting for taking that hit.
If they pull it off, it's substantial. They're projecting positive synergies, mostly from being more efficient, reaching about $7.4 billion a year by fiscal 2028. So that upfront cost is, a pretty small price to pay for that kind of sustained annual benefit.
And the main goal of all this is closing that PBR gap by cranking up their return on equity, their ROE. So what are they targeting? And how crazy is that target?
This is where you really see the ambition. Their ROE for fiscal 2024 was 4.6%. Their long-term goal is to hit 8% ROE during their next management plan, which starts after the merger in 2026.
An 8% target. What does that actually mean in context?
To put that 8% number in perspective for you, the average for similar regional banks in Japan right now is closer to 3.5%, maybe 4%. Aiming for 8% isn't just ambitious, it's a revolutionary target in Japanese finance. They're basically saying they're going to double their efficiency in just a few years.
And you can see that aggression in their immediate forecast, too. They're budgeting for $75 billion in ordinary profit and for $50 billion in net income for FY 2025.
Exactly. And they built in some upside. They noted that if the Bank of Japan hikes rates again, that could add up to another $10 billion to their net income. So they're ready for policy tailwinds. But that 8% ROE goal, that requires deep internal change, no matter what interest rates do.
Okay, so a massive ambition. This requires a strategy that goes way beyond just a local merger. What are the big moves they're making to get to that doubled ROE?
Well, the first big move is to build scale by looking beyond their home turf, beyond Nagano. In March 2025, they announced what they're calling the Fuji Alps Alliance.
Sounds picturesque. I'm guessing it involves more than just nice views. Who's in it with them?
The partners are Shizuka Bank and Yamanashi Chuo Bank. And it's not a merger, it's a comprehensive business partnership. The idea is to create this wide area alliance so they can support their customers across a much bigger geography, especially with complex stuff like M&A, business succession, overseas support. It's like creating a regional conglomerate without all the integration costs.
The goal is a cumulative revenue impact of $20 billion over 5 years. But why an alliance? If they need this aggressive change, isn't an alliance just a slower, less efficient merger?
That's a great challenge. The benefit is speed and low upfront cost. A full three-way merger would take years, massive system costs. It would completely stall their PBR mission. The alliance lets them start cross-selling and sharing knowledge immediately, especially on that high-value consulting stuff, while keeping their balance sheets separate. It's a very strategic move.
Okay, so moving from the external to the internal, the second leg of this strategy is their workforce. Hugely important in Japan's tight labor market. What are they actually doing with their people?
This might be the most transformative part. They're using the efficiency they gained from closing branches and streamlining things to reassign 200 employees. And they're moving them into strategic, high-value areas like consulting and digital strategy by March 2029. They've already moved 20 people.
Reassigning 200 staff. That is a massive undertaking. You're fundamentally changing people's jobs from, processing transactions to being value-add consultants. What are the cultural hurdles?
They're pretty open about them. You're merging two different ways of operating. Hachijuni is very systematic, process-driven. Nagano Bank is known for being faster, more flexible on the front lines, so they have to blend those cultures, which means a ton of internal training and clear communication. If they don't get the reskilling and the culture right, the whole thing could fall apart.
And that kind of change requires huge technological support, which brings us to the third leg, their digital transformation, or DX.
DX is the absolute backbone for all of this, for the efficiency and the human capital strategy. And they've made incredible progress. They've already completed over 92% of their big DX initiatives. They're using smart devices, data warehouses, everything.
What's the most surprising part of their DX rollout?
It has to be the internal Gen AI adoption. They built their own tool called 82 Copilot. And what's truly astonishing for a regional bank in Japan is the usage rate. It has over 3,700 users. That's almost 90% of their entire staff, full and part-time. This isn't some little pilot program. This is organizational saturation of generative AI.
That is genuinely groundbreaking. 90% of staff using AI every day. That shows a serious commitment.
Absolutely. And you can already see the results. The balance of business loans that were screened by AI grew over 70% last year. This is the proof they're shifting from being a traditional lender to becoming an information hub. They're not just allocating capital anymore. They're consulting on human capital, on efficiency for the entire region.
So the tech is boosting efficiency for sure, but Hachijuni is also betting that these long-term non-financial metrics, especially ESG, are going to be key to closing that PBR gap. So let's shift to that.
Yeah, sustainability is central for them because it's tied directly to Nagano's core assets, the clean water, mountains, tourism. For them, protecting the environment is protecting their business.
And their decarbonization targets. They look incredibly aggressive for any financial institution, let alone a regional one.
They're moving really fast. They just revised their targets upward. The whole Hachijuni group is aiming for net zero on their own Scope 1 and 2 emissions by fiscal 2025. For you listening, that basically means their own power usage and vehicle fleet. The parent bank actually hit that back in 2022. The bigger goal is an 80% cut versus 2019 levels by 2030.
And they're backing that with a huge amount of money.
A staggering amount.
Yeah.
A cumulative target of $1.5 trillion in sustainable finance by 2030. $1 trillion of that is specifically for environmental projects. And they're well on their way. They've already cleared my $162 billion by the end of last fiscal year.
The thing that stands out to me is how they're pushing their own customers on this. They're not just looking inward.
That's the critical step. They have a new goal to get their borrowers to track their own greenhouse gas emissions. Their target is to get 450 of their corporate clients calculating their emissions by fiscal 2025.
So they're using their financial leverage to basically force their whole regional supply chain to deal with decarbonization. That's a powerful signal. Okay, what about governance?
The governance changes are aimed squarely at that PBR problem, at building shareholder trust. They've loaded up the board with independent oversight, 5 outside directors, which is over 55%, and 3 of them are women.
And they're also strengthening their commitment to unwind strategic shareholdings, which has always been a big criticism of corporate Japan.
Correct. They've committed to getting those holdings below 20% of net assets by 2030. And crucially, they changed the metric. They're calculating it based on market value now, not book value. That's way more aggressive and transparent. It shows they're serious.
And all this is backed up by actual returns to shareholders.
For sure. The dividend keeps going up. The estimate for FY 2025 is 50, which includes a special dividend for the merger. And they've been buying back a ton of stock, $20.5 billion last year,
All right.
which is management screaming that they think their stock is undervalued.
So this brings us to the big question for you, the listener. How does this mix of regional focus, high tech, and aggressive capital management,
Yeah.
how does it change the investment thesis here?
The thesis shifts completely. I mean, you're watching a regional bank morph from a slow legacy utility that just handles payments and loans into a high-efficiency value delivery machine that's centered on consulting, on information, and on human capital. The reallocation of 200 staff, the 90% adoption of Gen AI, those are the things that, if they work, prove their profits are actually sustainable. This could create a huge split between the winners and losers in regional banking.
And that brings us to our final segment where we explore the implications of all this. And remember, this is purely for intellectual exploration.
This is not financial advice. But the context is clear. Hachijuni Bank is trading at half its book value. It expects record profits. It's raising dividends. It's buying back stock. Management is betting everything on this transformation.
So you've got this super aggressive tech-forward bank in a sector that's mostly seen as sleepy. What's the play that seems outrageous but might just be plausible?
The outrageous but plausible trade idea. You short the generalized Japan Regional Bank Index, while at the same time you go long the newly merged Hachijuni Nagano Bank.
A paired trade. So you're not betting on the sector, you're betting on one management team's ability to execute.
Exactly. The trade hypothesizes that this merger, plus the Fuji Alps Alliance, plus the employee reskilling, that it all creates a winner-take-all scenario. You're betting that the efficiency gains from this tech-enabled new bank actually let them hit that 8% ROE target. If they do, you'd see a massive re-rating where the PBR flies past 1x while all the other banks are left behind. You're betting on their execution.
Betting on the transformation over the status quo. A fascinating deep dive. Thank you.
My pleasure.
And for you, the listener, here's a final thought to chew on. Given this huge shift toward banks becoming information hubs and human resource consultants, what happens to the idea of bank being defined by its geography? When an alliance like the Fuji Alps stretches their influence across multiple prefectures, what's regional anymore? Something to think about until the next deep dive.